guys, it's Markets with May, and in this episode, we're going to be talking about volatility with as little math as possible. Volatility is super important in the options market, but given what's going on in geopolitics and in the stock market in general, a lot of people kind of just want to know what volatility is and how it's affecting them and how they should think about their own personal portfolios as a result. Now, volatility is technically a mathematical concept, but that concept is trying to describe something. Math always is an attempt to measure something in the real world. And volatility is something that every options trader is very keen on and knows both mathematically and intuitively. Now, volatility is a huge subject, so we're going to really break it down to just 4 things in this episode. First, we're going to go through some jargon words that you'll hear often in the area of volatility. We're going to talk about implied vol, and we're going to talk about historic vol. Second, we're going to talk about what causes volatility. And there can actually be a lot more causes than most people tend to think that just stay a little bit too in the weeds with the math. Third, we're going to talk about what might make volatility over and undervalued. Finally, and a bit more option specific, we are going to talk about what does it mean when you see volatility numbers that are over 100%. Before we get into that, to the extent that we use any specific securities in this video, this is not a solicitation to buy or sell any security or stock. Additionally, past performance is not indicative of future returns, and you should always consult someone locally who can better assess your financial needs. Also, it would mean so much if you could like, share, comment, or subscribe to my channel. It helps me know what kind of content is very helpful. Now, let's get into this thing, volatility, with as little math as possible. Now, when talking about volatility, there's a couple of different types of volatility that people will sometimes mention. And so I want to define 2 very commonly referenced types of volatility. The first is historical volatility. And oftentimes when people are just saying volatility, what they're really talking about is historical volatility. Second type of volatility is implied volatility. And that happens to be ever so slightly different. But typically when people are saying volatility, they're going to refer to some historic time period of up and down movements using a particular interval, typically daily. Now, because I'm saying typically this and potentially that, there's a couple of things that you need to know such that 2 people can have exactly different calculations. The first is absolutely people use different time periods. Some people might be using the last year of historical prices. Some people might be using the last 30 days. Some people are using daily data. Others are using hourly data. And in fairness, none of them is necessarily better or worse. It just depends on what you're trying to do. Additionally, it's very important to know that the volatility concept actually does map back to a normal distribution via a concept of standard deviation. Now, I know I promised math light, but all you really need to know on that is the volatility number, when you annualize it, should represent a 1 standard deviation move over the period that was quoted. So don't worry about the difficulty of the math. Just know that when you're quoted a 1-day standard deviation, let's say it's 1%, then what I'm saying is 68% of the time, that thing, let's say it's 1% on the S&P 500, that the S&P 500 will move up or down 1%, 68% of the time. Thus, if the S&P moves 5% that day, then that is a very large standard deviation move. Now, I want you to imagine if you're coming out of a period where the S&P 500 has barely moved, then yeah, that standard deviation number is going to be really low, and it's going to continue to increase because historical volatility is absolutely heavily influenced by the period that you choose and the immediate period that came forth. Now, in fairness, there's a lot of different techniques that the math nerds of Wall Street do to account for this historical lag, let's call it. And I promise you, they're not really as clever as you think they are, but there are a lot of techniques, and that's beyond the scope of this particular video. Now let's talk about implied vol. What you need to know about implied vol is that it is derived from the existing price of the option. So it is completely a calculated data point. You don't need any historical data. The key component there is that you need a price. But what happens is options are not always super liquid, meaning that the price is more or less very, very tightly bound. In the case where you're looking at options of a particular security or the index itself, and the bid and the offer are very wide, such that it would not necessarily be safe to just use the middle between the bid and the offer, that implied vol is a big fat question mark. So if you're using implied vol on something super liquid where it's usually fairly tight, 1 cent, 5 cents, it may be okay. It's not okay if the thing is 10 cents to begin with and you have 1 cent between it. That's a problem. So it really kind of depends, but just note that if you're getting implied vol numbers, or if somebody's using implied vol on a security that trades very wide, you're gonna have to double check that. Is implied vol better or is historic vol better? We're gonna get into that in further detail later, but it's just important to know that they are two different calculations, and as such, they can have two different meanings. And an options trader is going to feel very comfortable with both of those two meanings and be able to derive some thoughts on what that implies that the market is saying. Now, I would mention that the reason it's called implied vol is because the market is giving you the price of an option. And so therefore there is an implication of what the volatility therefore must be given that price. That's really clever terminology, but that's all it really means, implied vol. Now, the second thing I want to talk about is what causes volatility to begin with. Well, in the case of historic vol, you might oversimplify and say what causes volatility is up and down price movements, and that would be 100% correct. It's true. However, I don't think that gives you any kind of intuitive feeling or any type of thought process about what should you then think of. Now, the key thing to understanding the cause is to understand that volatility as a calculation sits within statistics. And within statistics, what we're trying to do is figure out the level of uncertainty. How uncertain is it? Is it very uncertain? Is it less uncertain? And so when you see different volatility numbers, that's really what they're saying. Let's say the volatility of NASDAQ is higher than the volatility of the S&P 500. Well, what we're saying is that the price movements of the NASDAQ are a little bit less predictable, more volatile, more uncertain than the movement in the S&P 500. Now, at this point, some of you have probably heard concepts that volatility going down necessarily means that the index is going up. And so you might be like, well, I'm a little confused. NASDAQ goes up oftentimes a lot more than the S&P 500. Why would that have a higher volatility than the S&P? Well, that's actually quite easy. A lot of times people think that volatility, it has this inverse relationship. Kind of, but if you think about how they're derived, it's really about the up and down movement. So if you have a lot of up movement and then you have some down movement, you can have skewed numbers, so to speak. And we'll just leave it at that because there is a whole set of math that goes with that that is beyond the scope of this particular video. But just realize what we're saying is that big up or big down movements should increase historical volatility. Now, I'm going to say, generally speaking, this is also true of options implied volatility, but there's a bit of nuance to it because with options, you can demonstrate just the upside vol and just the downside vol separate from each other via the different instruments. Again, beyond the scope, but all I really want you to understand is that when volatility for the S&P 500, for example, for a single instrument increases, what we're really saying is that uncertainty has increased. And if it decreases, then the market is saying, or the number is saying, whether it's true or not is a separate story, the number is saying that volatility and uncertainty has decreased. But that doesn't really answer the question of what causes the volatility in the first place. Well, it turns out what causes the volatility in the first place is literally anything that would make the security trade in a way that was less certain. So geopolitical situations can create uncertainty. A lack of liquidity can create uncertainty. Somebody reporting poorly can create uncertainty. Before they report can create uncertainty. Literally anything can create uncertainty. But as you have a lot more arrows pointing in one direction, so the key thing to note, no math, is that when you're looking at a volatility number and trying to assess, hey, how do I feel about this volatility number? It's really about, hey, how much uncertainty do I think is actually in the company or the index or whatever it is you're looking at. Now let's talk about over and undervalued volatility. Now, part of what inspired me to do a video on volatility, despite all the math, was because a lot of times on my show, I'll mention, oh, I just think volatility is way undervalued here or way overvalued here. And I mean something actually rather intuitive versus mathematical when I say that. To have more years in the market, you will match a volatility number with a set of activities that were going on in the market. So if you've lived through 99, 2001, 2008, and so on and so forth, then you have kind of an intuitive sense that the market volatility is too high or too low. Now, that intuitive sense often does map to a specific number. We're not going to deal with that right now, but I would just say, to make it simple right this minute, 20 would be a long-term historical vol. To just remember, there will be people that fight me on that because they're using a different time frame for how they're calculating historical vol. Historical vol is significantly higher than 20. I ask myself, is the market conditions more uncertain? And let's say we have a war going on in Europe, some sort of issue with energy as a crisis, we've got maybe a food issue, things like that. I'm going to be like, yeah, I think actually volatility should be a little higher than 20. So it's things like that that are just intuitive, regardless of whether or not you have a chance to layer on the math. Now, resolution on those things, more data points associated with those things, temporary reprieves on those things may bring volatility all the way down. Now, in the options market, because there is a time component, the closer you get to expiration, the time decays, the time component of volatility, meaning when things are way, way in the future, I can say whatever I want and there's a bunch of uncertainty. But when it comes right on top of it, and I'm also very, very close to either being right or wrong, that volatility is going to look a very particular way, and it will probably spike right into it and then decline. Now, if I'm nowhere near where I need to be as relates to that option strike, that is going to just go straight to zero because there's increasing certainty that it's never going to make my price. We'll talk about that in a different video on extrinsic and intrinsic value. So definitely subscribe if you are enjoying a more intuitive, non-mathy way of thinking about options. In simple terms, though, if uncertainty increased, volatility should go up. So let's say you have a company and it's going to report earnings and you're pretty sure that no one could possibly know the answer to that earnings because, I don't know, a war just happened, something like that. Then you would absolutely expect volatility to increase, and if it doesn't, you would think it was undervalued volatility-wise. If, in contrast, everyone is pretty certain that the company's going to do something and it does it, and then the volatility still doesn't change for an hour or so, then that volatility is probably overpriced. And that happens a lot during earnings season after a company reports. Maybe there's just a half a beat between the market reaction and that stock because people are still trying to figure it out just for a second. Then you can sometimes see volatility a little higher than it should be, and then it comes straight down. And depending on what side of the trade you're on, it could be a little bit of a problem or it could be amazing. Now, the last thing I'm going to address is what happens when you see volatility, particularly implied volatility, over 100%. You won't ever get historical volatility over 100% unless you're trading a very unique instrument that can go negative. But, and there are a couple where you could end up with it going negative, but it's more rare. But oftentimes you will see implied vol go well over 100%. And what that particular instrument is telling you, usually an option, but there are a couple of instruments that would also have a concept of implied vol. But usually what they're telling you is that the upside could be greater than 100% given how it's moving. Your downsides could be a big fat donut. So a lot of the meme stocks follow this sort of pattern and have that kind of implied vol. Now, I would caution you with the meme stocks that even though that's what the implied vol says, you should also note that that is really just trying to scream out, this is very risky. Because at the end of it, while I've said that volatility is uncertainty, that uncertainty is very risky. So the higher the implied vol or historical vol, the more risky that security is. And you can therefore use this metric to compare two stocks against each other as to which one is more risky. The S&P 500 will tend to have a fairly low volatility relative to any given specific stock. Well, that's all I have time for in this episode. In future episodes, we'll talk about other concepts and jargon words. Check out my list on jargon words. And again, if you would like, share, comment, or subscribe, I'd be thrilled. Have an awesome time in these markets. Good luck out there.